Welcome to Cambridge House Live. I'm Bridgitte Anderson, and with me is Adrian Day, the money manager and president of Adrian Day Asset Management, and also author of several books on global investing. Let's first talk about the commodity supercycle. Back in October, Citigroup said it was over. Would you agree?
No, not at all. I mean, when you look at the commodity super cycle, there's a few things to look at. First of all, cycles in commodities tend to last long times. You know, if you ask most people what's an economic cycle, they think 4 years, 6 years. But when you look at the commodity cycles, they tend to be very long anyway. Depending on how you measure them, the shortest cycle in the last 250 years has been 17 years. Mm-hmm. Now, you get broad, sustained, long up moves in commodities when you have a new source of demand from a newly developed country. And so you look back to 1815 to 1840, you got 25 years after Britain industrialized. You look at 1870 to 1914, that's 44 years after Germany and then the United States industrialized, and so on. When you look at China, we've now been going in this commodity cycle for 11 years. Why would we think that the commodity cycle sparked by China's new demand, China being 20% of the world's population, why would you think that's going to be the shortest commodity cycle on record? It doesn't make sense.
Yet there are some concerns about the pace of China's growth. It has slowed off in the last year or two.
Yeah, but we're now at the last quarter was 7.9%. You know, 7.9% growth with inflation under 3%, that's pretty darn good growth. And of course, we've got to remember that when you have a country like China that was dirt poor 25 years ago, obviously, once it starts to develop, the growth rate's going to be a lot faster. At the beginning of that cycle, when people have $200, $300, $400 of average annual income, now you're looking at $5,000 of average income. Well, it's a lot more difficult to grow at the same pace. So as the economy develops, you expect the rate of growth to slow down. But frankly, 7.9% rate of growth, that's nothing to sneeze at.
And there's still other emerging markets which are also developing very quickly.
Absolutely. Behind that, you've got India, which may take a while, but you've got Indonesia, Brazil, and these are all countries with very large populations. So when they really start to industrialize and urbanize, the growth will be very dramatic.
So this bodes well then for the resource market?
Oh, absolutely, absolutely. Because what happens is, as an economy industrializes and you get the urbanization, people move into the city, you get that emerging middle class, what happens is you get changing patterns of consumption. So the person that used to live in a wooden shack now wants a building that has steel or iron or steel or concrete, and he wants a television, and he wants a telephone, and he wants to switch his bicycle for a car. Well, obviously a car, needless to say, but it's important to sort of make it clear, a car takes a lot more resources than does a bicycle. And so the demand for resources across the board is just going to continue to grow, in my view.
Give me your thoughts about copper. You were talking about that a little bit here at Cambridge House in Vancouver,
Absolutely.
So let's chat about that.
Well, obviously, different commodities, different resources are going to grow at different rates. A lot of it depends upon primarily China's demand at any given moment for that commodity, but it also depends on the supply and the potential to increase the supply. If you look at copper right now, the stage of development where China is, the need for copper is really quite extreme, because you use copper in infrastructure, you use copper in transportation, you use copper in housing. And so at this stage and use copper in automobiles. So at this stage of development, those are precisely the things that China is building. And so the demand for copper from China is going to continue to grow in my mind. Conservative estimates put that growth at maybe tripling again. It's tripled over the last 15 years, but tripling again over the next 20 years. Now, if you look on the supply side, you know, you can look at all the potential mines that might come on stream in the next 20 years. And the truth is, we know today what the potential mines are in 20 years. There will not be a major copper producer in 20 years that we don't already know about. So you know what the potential is. If you look at all of those mines, you say, well, there's plenty of copper to meet China's demand. But that's assuming they all come on stream, and they all, which they won't. There's political problems, there's economic problems.
Which leads me to my next question about the junior mining sector.
Yeah.
This is a volatile sector. and there has been, it's been a rough year. 2012 was not a good year for the junior mining sector. So what do you see in store for 2013?
Well, I think to some extent more of the same. The reason is that it's very difficult to raise money. That's the problem. It's not the prices of commodities, it's just very difficult to raise money right now. And the junior sector, because most of them don't have any revenues, that's by their nature. An exploration company, most of them don't have revenues. They need to constantly raise money. It's a very difficult environment to raise money at anything other than egregious terms. So when I'm looking in this sector, I think there's two sides to this. One is it's going to be very difficult for a lot of companies, particularly those that don't have money. But on the other hand, I think this is a time, I haven't seen such good buys, good real value, companies that are selling at good valuations in 5 years since the bottom in '08.
So how do you identify those really good buys?
I'm not a geologist. And I always say that to people. So I'm not looking at a property saying, oh, I think this and this and this indicator means that it might turn into a good property.
And most of us aren't geologists, so...
So what I look at is exactly. What I look at is the company. I look at the company. Do they have good management? Do they have a good business plan that makes sense? And do they stick to that business plan? Let's not just listen to what they say they're going to do over the next 2 years. Let's look at what they said they were going to do 2 years ago and see if they've actually done it. And then lastly, but perhaps most importantly of all, do they have a good balance sheet? Mm-hmm. Because you look at some companies, a company might have $40 million in money. They might want to raise money, but if they can't raise it on good terms, they've got money to survive. You look at other companies that only have enough money to last 6 months, they've got to raise money.
So there could be an argument to be made that over the next 12 months or so, another volatile year for the sector will actually clean some of those companies out that maybe need to be.
I think so, and you hate to say that, but I think so. I mean, the problem is, or the way I look at it, remembering that I'm not a geologist, the way I look at it is, I don't care how good the property is, bad management with no money will manage to mess it up. Nearly said something I shouldn't. But a lousy property with good management, with a good balance sheet, they'll find something else. So I'll bet on management with money anytime.
Now you like royalty companies. Can you walk me through what that means exactly?
Yeah, a royalty company basically is a company that buys a royalty on on someone else's property. It can be a producing property, or it can be an exploration property. More and more and more royalty companies are actually creating royalties by going to a company and saying, look, we'll fund your exploration in return for a royalty. Now the beauty of a royalty model is that once the company has bought the royalty, they're not obligated to spend another dime. So you buy a royalty on a company, it doesn't matter if the government confiscates it or if the government raises taxes on it. If the government raises taxes, that's bad luck for the miner, but the royalty still gets 3% off the top. I mean, that's what the royalty is, 3% off the top. So it can be an unprofitable mine. I mean, eventually, of course, it might close, but I mean, it could be a mine that's not very profitable, and everything you think of can go wrong with it, but the royalty company still gets the royalty.
And are there good opportunities in that space?
I think so. I mean, Franco-Nevada's the largest one, $4 billion market cap company, Canadian company. I think that's the best by far. It's about $54 right now. These are not cheap. If you wouldn't look at these and confuse them with value stocks,
right.
They're not. But a company like Franco, for example, it's got $1.2 billion in cash on the balance sheet, no debt. It's generating about $400 million a year in free cash flow. So it's super strong balance sheet. They can go out and buy things, and they don't have to overpay. So yeah, and then there's some smaller ones as well that I like.
Now, aside from management, when it comes to looking at where you're going to put your money, are there any jurisdictions that you are really avoiding right now?
Yeah, that's a good question. I mean, clearly, with jurisdiction as well as a lot of other things, it depends on the price. I'll buy a risky jurisdiction if the price is low enough. But the way I look at it, and different people look at it different ways. But the way I look at it is you're taking enough risk in the resource exploration business anyway. Only 1 in 7,000 anomalies ever becomes a mine. So you've got all the risk you could possibly hope for in any of these companies. why take on more risk by going to a risky jurisdiction? So unless it's a very diversified company, like in the big caps, I like Freeport Copper, or Freeport's in Indonesia and Irian Jaya and the Democratic Republic of Congo, and anytime a country calls itself Democratic Republic, you need to be a little bit cautious of it. There's only one thing worse than that, and that's if it's the People's Democratic Republic. But, they're in some pretty risky places, but they're diversified. But if you're looking at a junior and all of their assets are in a risky country, I would personally avoid it, because you're taking enough risk anyway.
Okay, it's some great insight, Adrian.
Yeah.
Thanks so much for your time.
Well, thank you very much. It's fun.